Welcome back to the deep dive. Today we are looking at a story that feels a bit like a corporate magic trick.
It really does.
Usually when you analyze a company, you're looking at a linear path, right? Company A makes widgets, they sell more widgets, and eventually they just become a bigger widget maker.
Right, the standard growth model.
Exactly. But today we are looking at a company that pulled a complete vanishing act and just, reappeared as something entirely different.
It's a fascinating case of corporate metamorphosis.
Mm.
We are talking about Luminar Media Group, ticker symbol LRGR.
Right. And if you pulled up the filings for LRGR, say, 3 years ago, what were you looking at? You were looking at prestigious brands.
Mm-hmm.
You were looking at spices, wines, spirits, just a classic consumer retail portfolio. But if you look at the filings today, February 28th, 2026, that spice rack is completely gone.
Yeah, completely wiped clean.
And in its place is this high-growth fintech platform posting triple-digit expansion numbers.
It is a radical shift. And I think what makes this deep dive so interesting isn't just the fact that they switched from Chianti to Capital.
Right.
It's the how. This is a masterclass in financial engineering.
Yeah, we're going to unpack the mechanics of a reverse recapitalization. We're going to dissect how a company scrubs away toxic debt and look at why a specific group of new partners is betting big that this former wine merchant is actually headed for a major exchange.
And we have a really comprehensive stack of sources to guide us today.
What are we looking at?
So we've gone through the amended annual reports from 2024 to understand their baseline. We have the quarterly filings from throughout 2025, which show the pivot happening in real time.
Okay.
And crucially, we have some very recent documents. There's specific convertible note agreements, a press release from December 2025 regarding a massive debt settlement, and an operational update from January 2026 that gives us the raw performance data.
So we have the map. And our mission for you listening is to figure out if this transformation is just skin deep or if there's a real profitable engine running under the hood.
Exactly.
So let's start at the beginning, or I guess the new beginning. Take us back to May 2024.
May 24, 2024. That is the pivotal date. That's when the reverse recapitalization actually occurred.
Reverse recapitalization. It's a mouthful. For the listener who might not be a CPA, can you break down what that actually means in plain English?
Yeah, think of it as a hermit crab strategy.
Okay.
You have a private company, in this case a fintech entity called FRTU LLC. They want to be on the public markets, but a traditional IPO is slow, it's expensive, and risky.
So they find a shell.
Right. They
Yeah.
find an existing public company, Luminar, that's maybe a bit sleepy or looking for a new direction. They merge. But in reality, the private company takes over the public company's body.
Right.
On that date in May, the old business assets, the wine, the spirits, they were spun out. Luminar then issued about 38 million shares to the owners of FRTU. So the Fortune team ended up holding the majority of the stock, effectively taking the wheel.
I love the analogy of an engine swap. You have a car driving down the highway. That's the public listing, the ticker, LRGR. You pull into the garage, hoist out the old diesel engine that was hauling spices, and just drop in a high-performance electric motor.
That's exactly it. The license plate hasn't changed, but the machine powering the car is completely different. The management, the strategy, the revenue source, it all flipped overnight.
So let's talk about this new electric motor, Fortune. What do they actually do? Because fintech can mean anything from crypto wallets to payment processing these days.
Fortune is very specific, and I think that's an important distinction based on their About section in the filings. They operate in the revenue-based financing sector.
RBF. Okay, let's unpack that for a second.
Imagine you run a small business. Let's say a family-owned restaurant or a boutique retail shop. You need $50,000 to renovate or buy inventory for the holidays. If you walk into a major national bank, what happens?
Oh, they ask for 3 years of tax returns, your personal credit score, collateral, your firstborn child, and then they tell you maybe in 6 weeks.
Exactly. The friction is incredibly high. Fortune steps into that gap. They don't rely solely on FICO scores. They look at the business's actual cash flow, the daily deposits. They advance the capital up front, and in exchange, the business pays back a small percentage of their daily sales until the total is repaid.
So if the restaurant has a slow Tuesday, they pay back less.
Correct. It aligns the lender with the borrower's success. It's flexible, and Fortune has carved out an even more specific niche. They are specifically targeting underserved Latino and minority-owned enterprises.
Which is a massive demographic. We know that statistically, minority-owned businesses often have the hardest time accessing traditional bank credit, despite having really strong cash flow.
It's a classic market inefficiency. Big banks see risk because their models are outdated. Fortune sees opportunity because they use data.
So the theory is sound. High growth sector, underserved niche. But theories don't pay the bills. Is this new engine actually working, or is it just sitting in the driveway?
The data suggests it is running and running hot. We have the press release from January 20, 2026, which gives us the preliminary metrics for the full year of 2025.
Hit us with the numbers.
First off, consistency. They reported their 7th consecutive quarter of growth. That tells me this isn't a fluke, it's a trend. But the raw volume is what really jumps out. In the fourth quarter of 2025 alone, their gross funding volume, that's the total cash they deployed, hit $3.9 million.
3.9 million in one quarter. How does that compare to the past?
It represents a 109% increase compared to the same quarter the previous year. They effectively doubled their output.
Wow. And if we zoom out to the full year?
For all of 2025, the gross funding volume was $12.3 million. That is up 280% from 2024.
280% growth. That is the kind of number that makes growth investors sit up and take notice.
It is aggressive scaling. But as an analyst, I always look for the other side of the ledger. It's easy to give money away. The hard part is getting it back.
Right. If you're lending money and nobody pays you back, that's not a business, that's a charity.
Precisely. That's why the receivable cash deposits metric is so critical. This tracks the cash actually coming back into Fortune's accounts from their clients. For 2025, that number hit $11.5 million.
That tracks very closely with the funding volume.
It does. It tells us the portfolio is performing, the money is churning, they lend it out, it comes back with a return, and they lend it out again. This confirms that the pivot wasn't just a press release. The operational reality actually matches the story.
So operationally, the patient is healthy, the new heart is beating strong, but, and there's always a but in these turnaround stories.
We have to talk about the skeleton in the closet, or in this case, the skeleton in the basement.
This brings us to section 2, cleaning the cap table. Because when Luminar absorbed Fortune, it didn't just get a new business, it kept some old baggage.
It did. And this is where we get into the financial engineering side of the deep dive. We need to talk about legacy convertible notes.
Explain legacy debt for us.
When the merger happened, the public entity still had outstanding debt instruments from the old regime. We see names in the filings like VSJJJ, LLC. These were convertible notes. Now, normally a convertible note is fine. It's a loan that can turn into stock. But the terms on these specific notes were, let's call them toxic.
Toxic how?
The conversion price was fixed at 1 cent per share. 1 penny.
Whoa. Let's pause on that math. If the stock is trading at, say, 50 cents, and I can convert my debt into shares at a penny, I'm going to get a mountain of shares.
A massive mountain. It's simple dilution math. If I owe you $10,000 and the stock is $1, I give you 10,000 shares. If I owe you $10,000 and the conversion price is a penny, I have to give you 1 million shares.
And if those note holders decided to convert, they would flood the market with millions of new shares.
It would have been catastrophic. It's called an overhang. As long as that debt existed with those terms, it was like a sword hanging over the stock price. No serious institutional investor would touch the company because they knew their investment could be diluted to nothing at any moment.
So Luminar is showing 280% operational growth, but they are being held hostage by this penny stock debt structure. How did they solve it?
They executed a comprehensive settlement. This was announced just recently on December 18, 2025. It is arguably the most important event in the company's recent history outside of the merger itself.
How do you settle something that toxic?
You negotiate.
Yeah.
The company sat down with the legacy holders and settled all outstanding legacy convertible notes. The aggregate principal was around $391,000. Now listen to this. Under the old penny terms, that debt could have converted into over 39 million shares.
39 million shares. That is a lot of paper hitting the market.
But through the settlement, they agreed to extinguish the debt for just 7.9 million shares.
Wait, they talked them down from 39 million potential shares to just under 8 million.
Correct. That is a reduction of nearly 80% in potential dilution.
That feels like a massive win for the company. Why would the lenders agree to that, though?
It's the logic of a haircut. The lenders probably realized that if they flooded the market with 39 million shares, the stock price would crash to zero, and their shares would be worthless anyway. By taking fewer shares in a healthier company, they actually stand a better chance of making money.
That makes perfect sense. Better to have a smaller slice of a growing pie than a huge slice of a pie that's on the floor.
Exactly.
Was there any other safety mechanism in that settlement?
Yes. The settlement included a lockup. The legacy investors agreed they cannot sell those new shares for 6 months following any future listing on a national exchange.
A lockup, that stops the dump part of a pump and dump.
Right. It stabilizes the stock. It tells the market they're cleaning this up for the long haul.
And this cleanup effort doesn't stop there, because this perfectly sets the stage for a major structural move we need to discuss, the 10-for-1 reverse split.
Yes, the reverse split is a critical piece of the puzzle here. By consolidating every 10 shares into one, they instantly multiply the share price by 10 without changing the company's actual market value.
Which is pretty much a prerequisite if you're trying to uplist, right? You can't show up to the NASDAQ trading at pennies.
Exactly. Exchanges have minimum bid price requirements. The reverse split is a mechanical step to graduate from the OTC markets.
So the basement is dry, the toxic waste is gone, and the share structure is getting dressed up for the big leagues. Now let's look at who is moving into the house. This brings us to Section 3, the new partners. Because not all debt is created equal.
This is a crucial distinction. We often hear debt and think bad. But debt can be a strategic tool if the partners are right. Starting in April 2025, we see a new group of investors entering the picture. We see entities like Saluda Group, LLC, For Isabella, LLC, and Renzo's Legacy.
Saluda and For Isabella, are these just more penny investors?
No. And this is where you have to read the fine print in the convertible note agreements. The terms here are fundamentally different from the toxic legacy debt.
How so?
The toxic debt incentivized a lower stock price so they could get more shares. These new notes, which mature in 2027, have a conversion price linked to 50% of the stock price. But, and this is the aha moment, there is a specific trigger.
What's the trigger?
The conversion rights do not become exercisable unless and until the company is listed on a major U.S. securities exchange, specifically NASDAQ or the NYSE.
Hold on. Let me make sure I understand the gravity of that. These investors, Saluda, For Isabella, they gave Luminar capital, but they cannot convert that debt into stock unless Luminar actually graduates to the big leagues.
That is correct. It is a transition to long-term equity ownership by committed partners.
That completely flips the script on incentives.
It does. In the old model, the lenders won if the company stayed small and the stock was cheap. In this new model, Saluda and For Isabella only get their equity upside if the company succeeds in uplisting.
So they are true partners. They are in it for the long haul, aligned with the company's multi-year growth trajectory. They aren't looking for a quick flip. They are betting on an institutional exit.
Exactly. It frames this capital not as a burden, but as a bridge.
And speaking of capital and bridges, this transitions right into their upcoming capital raise. They are targeting a $10 million raise at $5 per share.
Yes, the $10 million at $5 a share, combined with that 10-for-1 reverse split we talked about, shows a very clear, coordinated strategy.
So it's not just a pipe dream. In Section 4, let's talk about the roadmap. Is there a concrete plan to get there?
There is a paper trail that suggests uplisting is the primary strategic goal. We found an agreement dated August 20, 2025 with a firm called Greentree Financial Group.
Greentree, what is their role in this?
The contract specifically states they were hired for uplisting support in connection with the company's planned public offering.
That's pretty unambiguous language.
And again, look at the compensation structure. Greentree receives additional equity only upon a successful uplisting to a national exchange.
I am seeing a pattern here. Everyone, the new investors, the consultants, the management, they are all rowing in the exact same direction. Nobody gets the big payout unless the bell rings on Wall Street.
It creates a powerful convergence of interest. It minimizes the conflict between shareholders and financiers.
So we have the team, we have the cleanup, and we have the goal. What are they doing with the actual cash? You know, the $12.3 million in funding volume, plus this new $10 million raise they are targeting?
Based on the January 2026 PR and the broader strategy, it's about reinvestment and strategic portfolio acquisitions. The capital raised from these partners isn't going to pay for fancy offices. It's fueling the Fortune platform's lending capacity and acquiring strategic assets to scale faster.
It's that flywheel effect.
Yes. In the lending business, capital is inventory. The more cash you have, the more loans you can originate. The more loans you originate, the more data you collect, which lowers your default rates.
And as those $11.5 million in deposits come back in, you lend them out again. And with the new capital for acquisitions, they can drive sustained sales and profit growth at an even faster clip.
Exactly. Because they are targeting that specific minority-owned niche, they are tapping into a market with high demand and arguably less competition from the big banks. It allows for sustained growth because the market isn't saturated.
It sounds like a solid machine. But part of our job is to remain impartial here. We have painted a very rosy picture of a turnaround. What are the risks? What should you, the listener, be wary of?
We have to be realistic. While 280% growth is impressive, this is still a company in transition. The debt settlement in December 2025 was very recent. They are still navigating the complexities of being a public company.
An uplisting isn't a guarantee.
No, it's not. The Nasdaq has strict requirements. Share price, shareholder equity, corporate governance. Just because you hire Green Tree and plan a reverse split doesn't mean you automatically get in. There's execution risk.
Right.
If they fail to uplist by 2027, when those notes mature, they will have to deal with that debt in cash.
So the clock is ticking. The maturity date of the notes is the deadline?
Effectively, yes. They have built a runway. They've cleared the debris from the runway with the debt settlement. They are fueling up with a new capital raise, but now they actually have to fly the plane.
It really puts the stakes in perspective. This isn't a passive hold. It is an active execution play.
And that is why the new partners are so important. By locking their conversion to the uplisting, Saluda and Forzabella have signaled that they believe the plane will fly. They aren't betting against the pilot.
Let's bring this all together for the outro. This has been a wild journey through corporate restructuring.
It really is a classic turnaround story, but with a modern fintech twist.
We started with a shell company, Luminar, that was a ghost of a retail business. In 2024, they swapped the engine, bringing in Fortune and its minority-focused lending model. 2025 was the year of proof. Massive growth in funding volume, proving the need in the market. And then, December 2025, they scrubbed the deck, getting rid of the toxic legacy debt that would have capsized the ship.
And now, as we sit here in early 2026, they are initiating a reverse split, targeting a $10 million raise at $5 a share, and are aligned with non-toxic partners who are contractually locked in for the long haul, waiting for that uplisting trigger.
Why does this matter to you? Because it teaches you how to look deeper than the ticker symbol. If you just looked at LRGR on a generic stock screener 3 years ago, you'd see a struggling wine company. If you didn't read the footnotes today, you might miss the fact that the penny stock debt is gone and replaced by strategic institutional capital aimed at portfolio acquisitions.
It highlights the importance of structure. A company is more than just its product. It is about how its capital is organized. The shift from toxic debt to strategic uplist contingent debt is the real signal in the noise.
So here's a final provocative thought for you to mull over. We know the growth engine is running hot, triple digits. We know the toxic overhang is gone. The partners are locked in. The big question now is, with everyone incentivized for an uplisting and the paperwork clearly being prepped by Green Tree, how will the broader market react when Luminar finally rings the bell on a major exchange?
Will the market still see the past, the spices, and the penny stock history? Or will it see the future, the high-growth fintech platform? That perception gap is where the story gets really interesting.
Keep an eye on those gross funding metrics in the next quarter. If they keep doubling, the market might not have a choice but to pay attention. Thanks for listening to this deep dive into Luminar Media Group. We will see you on the next one.